Last week, the stock market saw some dramatic shifts. The stock market, a place usually known for its predictability, suddenly became a roller coaster ride. The fluctuating highs and lows were reminiscent of a topsy-turvy trading session, with the Dow Jones Industrial Average gaining more than 400 points at one point, and then falling around 130 points on the same day. The S&P 500 and Nasdaq weren't exempt from this volatility either. Both ended the day lower, with the S&P 500 sliding by 0.7% and the Nasdaq falling by 1.1%. This was a surprising trend, given the lack of major earnings reports or significant economic reports that usually act as catalysts for such swings. Amidst all this, the ghost of inflation seemed to lurk in the shadows, spooking Wall Street. The increased likelihood of more interest rate hikes from the Federal Reserve added to the anxiety, leading to higher long-term bond yields. This wave of uncertainty was not helped by the negative comments about the global economy from influential figures such as J.P. Morgan Chase, CEO Jamie Dimon, and the International Monetary Fund. These comments stoked the flames of recession fears, causing an even greater stir in an already turbulent market. The shifts we've seen in the market recently have brought a level of uncertainty that is palpable. Investors are on edge, speculating about whether the market will continue to decline before finding a bottom. These shifts have brought a level of uncertainty to the market, leading many to wonder what the future holds. There are several factors at play in these market movements. First off, it's noteworthy to mention that the anticipation of major American companies preparing to report their earnings for the fourth quarter is causing a stir in the market. This expectation often comes with a degree of uncertainty, and in this case, it's prompting a sense of anxiety among investors. The question on everyone's mind is, will these companies meet, exceed, or fall short of expectations? The answer to this question could either calm or further agitate the markets. Secondly, let's talk about the US dollar. It's been on a roll recently, surging in strength. This might sound like good news, but it's a double-edged sword, especially for multinational blue-chip companies. A stronger dollar means that profits made overseas are worth less when converted back into dollars. This potential impact on profits is another factor causing the market to wobble. Next up is the speculation surrounding the market's direction. After a series of drops, there's been a lot of chatter about whether the market will continue to decline before it hits bottom and starts to recover. This uncertainty adds to the nervous energy swirling around the markets. It's like watching a suspenseful movie. You're on the edge of your seat, not quite sure what's going to happen next. Lastly, we have the CNN Business Fear and Greed Index. This tool measures what emotions are driving the market. Currently, it's indicating extreme fear levels. This suggests that investors are feeling more pessimistic than optimistic about the market's future. It's like a mood ring for the stock market, and right now the mood is decidedly fearful. These factors combine to create a complex picture of the current state of the stock market. It's a blend of anticipation, uncertainty, speculation, and fear. But remember, the market is a living, breathing entity that ebbs and flows with these factors. It's always changing, always in motion. That's what makes it so fascinating, and at times, a little nerve-wracking. Despite the uncertainty, it's crucial for investors to stay informed and make calculated decisions. Now, let's talk about the importance of not overreacting to daily market moves. It's easy to get swept up in the fluctuations of the stock market, especially when headlines scream about dramatic losses or gains. But reacting to these daily shifts can lead to impulsive decisions that may not align with your long-term investment goals. Instead, it's advisable to focus on long-term investment strategies. This means looking at the bigger picture and considering the overall trends and potential of your investments over an extended period. And this brings us to a key point. Timing the market is less important than time in the market. It's a common saying among investors, and for good reason. Attempting to time the market, or buy low and sell high, is a risky strategy that even seasoned investors struggle to execute successfully. Instead, spending more time in the market, consistently investing, and benefiting from the power of compounding returns can yield more reliable results in the long run. But to do this effectively, you need to stay informed. This doesn't mean just keeping an eye on the daily ebbs and flows of the market, but also being aware of wider economic trends, understanding the factors that influence the market, and regularly reviewing and adjusting your investment strategies as needed. Making informed investment decisions requires a balance of knowledge, patience, and strategic thinking. It involves understanding your financial goals, doing your research, and making decisions based on that research rather than reacting to the market's daily movements. Remember, knowledge is power. Stay informed, stay strategic, and navigate the stock market with confidence.